Do you worry a 2026 market crash could wipe out decades of your retirement savings? The truth is, even if 2026 is the next big crash, it's not the crash that'll ruin your retirement. It's what you do next. So in this video, I'm going to show you whether you need to be worried about a crash in 2026, the one investment mistake that makes retirees lose money when they don't have to, and how to invest confidently no matter what the year brings. To start, let me show you why so many people are warning we're on the edge of the next big crash, and whether the signals are really as dangerous as they sound. This graph shows how much of the S&P 500 is made up of just one sector, tech. Right now, it's over a third of the entire index, the second highest level in 30 years. The only time it was higher was in March of 2000, and what followed was one of the worst crashes in history at the end of the dot-com bubble, with the NASDAQ falling nearly 80%. But when we look at the market today, there's something that might make 2026 even more dangerous than 2000. This next chart shows how much of the S&P 500 is now driven by just 7 tech giants, the Magnificent Seven. Right now, these 7 companies make up more than a third of the index. That means hundreds of other companies, the rest of the market, have never mattered less, and just a handful have never mattered more. That's why Morningstar recently ran a headline that caught a lot of attention: why your S&P 500 index fund might be more risky than the internet bubble. So when people say the market feels stretched or risky, they're not being paranoid. We're back at record levels of concentration, not just in one sector, but in a handful of stocks. And the last time we saw something like this, it didn't end well. But just because concentration was high before the 2000 crash, does that mean one is guaranteed now? To answer that, we need to zoom out and look at what's actually happened the other times the market reached this extreme level of concentration. Over the last 100 years, the market has hit similar concentration levels 7 different times. And here's the surprising part. In 5 out of 7 of those times, including right after the 2008 crisis and the COVID recession, the market didn't collapse. It moved higher in the year after concentration peaked. So history is clear. Extreme concentration can feel dangerous, but it doesn't automatically mean a crash is coming in 2026. And if you treat it like a sell signal, you risk pulling out before the market moves higher. But even though the market grew in many years following high concentration, most retirees' portfolios didn't. And it's because of one mistake that turns a temporary loss into permanent damage. Let me show you what happened in 2008 so you don't do the same. This shows how a standard 60-40 stock-to-bond portfolio performed during the financial crisis. The market dropped sharply, but within 2 years, it fully recovered. But here's what actually happened to the average investor. Morgan Stanley tracked real behavior when people pulled money out of retirement accounts and when they put it back in. The second blue line shows the result. Most investors sold during peak fear, not quite at the bottom, but close, and they re-entered after the recovery had already begun. So they avoided part of the fall, but missed the rebound. And by the end of the period, they ended up significantly worse off than if they had just stayed invested. So even after one of the worst market crashes in history, the market recovered. But the average retiree didn't because they bailed out too early and came back too late. But knowing what not to do in 2008 is one thing. If you want to invest with confidence in 2026, you need to understand what actually works, not just in one crash, but across nearly a century of downturns. This chart shows the worst drop the market went through each year going back nearly 100 years. And as you can see, almost every single year there's a moment that feels like a reason to panic. But what actually happens when you move into cash to try and stop the bleeding? Vanguard looked at every time the market fell at least 5% and tracked what happened when investors bailed out. If you moved into cash for 3 months, you underperformed 61% of the time. At 6 months, that jumped to 72%. And after a full year, like many did in 2008, you underperformed nearly 80% of the time, with a median gap of 9%. So across decades of data, the result is clear. Trying to time the market doesn't work, and moving into cash almost always comes at a cost. But it's easy to say you won't try to time the market. When your retirement account drops by 6 figures in a matter of weeks, it's a whole different story. That's when most people panic and lock in losses that take years to recover from. Smart retirees avoid that because they prepare differently, in 3 specific ways. If you're a subscriber, you know how missing just a few of the best days in the market can crush your returns. But instead of focusing on the best days, I want to show you when the worst ones happen, so you don't move into cash and miss the recovery that can make or break your retirement. This chart goes back nearly 50 years and shows the 20 worst trading days in the market. 9 of those happened in years where the market still finished up. So what feels like the start of a crash is often just noise, and reacting too early means missing out on the upside that follows. That's why smart retirees welcome volatility. They know a bad day doesn't mean a bad year, and they've built a plan that keeps them invested while everyone else is bailing out. The second difference in how smart retirees invest is a strategy Warren Buffett has used for decades, and it's what helps them stay calm when everyone else is constantly checking their accounts. This chart starts in 2000, right after the tech bubble peaked. The green line shows where most investors were concentrated, the hottest tech stocks everyone said were the future. But when the bubble burst, those portfolios collapsed and never fully recovered. Buffett has a famous line, "Be fearful when others are greedy and greedy when others are fearful." While most investors chased the hype, the blue line showed the stocks they ignored. The boring stocks that didn't make the headlines quietly outperformed. And through 2 major bear markets, those are the stocks that kept retirement portfolios alive. That's why the smartest retirees don't chase what's exciting. They build portfolios that can carry them through any market, just like Buffett has for decades. But even a well-built portfolio still goes through painful drops. And when your life savings are falling fast and headlines are screaming, it's hard not to panic. But smart retirees don't flinch, and this next chart shows why they don't have to. This shows the last 30 years of market history and the world events that shook it. If I told you that you lived through the biggest crash since the Great Depression, a global financial crisis, multiple wars, and a dozen other reasons to panic along the way, you'd probably assume your portfolio didn't survive it. But someone who invested $1 million at the start of this timeline and simply stayed the course would have nearly $6 million today. So what smart retirees know is that there are always reasons to panic. But the further you zoom out, the clearer the trend becomes. Even through the scariest drops in events, the market keeps moving forward. So now you know that the warning signs don't automatically mean a crash is coming in 2026. The one mistake that makes retirees lose money when they don't have to, and the 3 ways to invest with confidence no matter what the market brings. But even with the perfect strategy to defend against the crash, there's still one risk most retirees never see coming: retiring with plenty of money but feeling too anxious to actually spend it. Watch this next. It'll show you data that can flip that fear and help you start enjoying the retirement you've earned.